Okay, so today we go straight to another important standard, highly examinable standard. This standard is the IFRS16 leases. Before this standard was amended, we had a standard that was governing leases, and that standard was coded as IS17. It had its own flaws. It's also vulnerable to creative accounting. The IS17 would give the players an opportunity to differentiate what was called the operating or financial lease. So that which was regarded as operating would actually find itself in the income statement or expensed. So some certain leases, based on how it has been classified, would be off balance sheet. It will be an off balance sheet item. And as such, it became a tool for creative accounting, like I had said earlier. So by 2019, I think it was effective January, there was a new standard on the block, or a new kid on the block. Amended standard, fine-tuned to reduce the inadequacies that were there under IS17. This standard, it ring-fences most of the wrong things that were under IS17. What I mean is that all the leases, they'll have to find themselves in the balance sheet, though there are exceptions, just about 2 exceptions. One is on the value. If the value is insignificant, the value is below, at least from the standard, they're saying below $2,000, then that particular lease is going to be expensed. Or if it is a low value, or the low value, or if the contract, is short term, it's within 1 year, then there is no need to have it in the balance sheet to be an off-balance sheet item. So it's just on the issue of the value, if it's significant, or if the contract is short term. Otherwise, any other contract, as long as it's a lease contract, has to be on the balance sheet. Like I said, because even when you're given the theory, sometimes it's better coming up with a background, like just a background sentence. Yes, this is standard. You need to know, when was it adopted? When did it come into effect? What was there before the standard? And for having amended or coming up with a new standard, what were they trying to cure? Because what motivated them? Otherwise, it would not make sense. What motivated them in coming up with a new standard? So let's look at the overview of this. Sorry, I should have changed the first part. of this standard, not the PPE. My apologies, I was using the same template I used and for IFRS16. My apologies. So like I said, what they were trying to cure, because in the IFRS16, the standard was actually open for creative accounting. Now this standard, what it's doing is, it's making sure that all the leases are brought onto the balance sheet, except in the following circumstances, which I've already explained. That is on the contract, if it is within 1 year, and if the value is insignificant. So the accounting for low value or short term, like I said, they will not actually sit in the balance sheet or on the balance sheet. They will have to be expensed. These items, they can be computers, small value items. The contract could just be within 1 year, so there will be no need for you to having it in the balance sheet, on the balance sheet, sorry. So there is an example here. Example 1 on low value assets. It reads, Banda leases out a machine to Munyama under a 4-year operating lease. And the Munyama elects to apply the low value exemption. So the moment he applies that low value exemption, all that comes into our mind is that it is not going to sit in the balance sheet. The terms of the lease are that the annual lease rentals are 2,000, payable in arrears as an incentive. Banda grants Munyama a rent-free period in the first year. Explain how Munyama would account for the lease in the financial statements. So this is what we'll do. So we have been given the annual lease. We have been given the period of leasing this. Then we've been told that it is actually payable in arrears. And there's a key one, which is rent-free. So instead of paying for 4 months, Munyama will pay for 3 months. So meaning that it will be 3 times 2,000. So an annual computation will compute divided by 4, because we'll have to actually charge that. So what is the value? 6,000 divided by 4, it gives us 1,500. So this is what will be charged in. This is what will be charged in the P&L. But what is actually going to be happening is that every year there will be a release of 500. Because then this one you have at the end of the year, this is what you're going to show as charged, 1,500. So for 4 years, it will be 151515, but you are technically releasing a 500, because otherwise we're not gonna balance. We know that for the first 1 month, that has actually been given. It's an incentive. So an incentive can come in form of cash, and you are going to see it. And in this case, because you have just been given by your landlord an incentive, so that 500, you'll be releasing it. It's more of like an income of some kind. And I've seen this. It's so common in Johannesburg. Last time I went there, just Johannesburg, the heart of Johannesburg, where me and you are found. You would find they would say, no, the houses, the rentals is this much. But for the first 2 months, it's free. Or first 3 months is free. I used to wonder what's the sense in it? It's more of an incentive to, like an appetizer of some kind. Maybe a trap, but a trap may sound a bit toxic. But it is an incentive. So when you read the document that I sent, the 21-page document, is quite heavy. It has all these nuances stated in there. It's like it's a church. You're too quiet.
No, we're listening to Coach.
Okay, thank you so much. So I have already explained the accounting that is going to happen here. That 500 is coming in as an incentive. So eventually in the 4 years, because you see, you're not going to show this 500 times 4, for example. It takes you to your 2,000. But you cannot show it in the first year and show it as an incentive. No. You spread it across the contract period. So meaning there'll be 500, 500, 500 as an incentive. But what you recognize is a 2,000. That is what is supposed to be your lease payment. Identifying a lease. So the definition of a lease clearly gives us an idea of what type of a contract makes up a lease. Not all contracts are leases. And there are some special terminologies that I'll draw you to. Let me do this. It says a contract is or contains a lease if it conveys the right to control the use, the right to control the use of an identified asset. This is key. For a period of time in exchange for consideration. So one is when you are looking at, because in the exam, you can be given a scenario and the examiner would want you to state whether that particular scenario that has been given contains a lease. One of the things that you need to look at is, does the lessee have the right to control the use of an identified asset? Has the right to control the use of an asset? And is that asset identified? If, for example, Victor, we enter into a contract and I say, you'll be using a Toyota Corolla to pick your children from school for 3 years. The question you need to ask yourself is, do I have control of that asset? Is that asset identifiable? Does the term Toyota Corolla in itself, does it actually state in a way that it's an asset that I can identify with? So you may find that it is not a lease or does not contain a lease because just Toyota is a brand. You cannot identify that asset. Maybe you needed a red Corolla with a specific engine number, chassis number, so that you know that this is the motor vehicle. This is a car that the leaser has provided to me over this particular period of time. And I have control. It's an asset that I'm able to identify. We see it so many times. Imagine you are actually renting a place on lease. Then the owner of the place comes and says, no, here you shouldn't have done this. This is what you should have done. That is what you should have done, blah, 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 blah. Then that particular contract does not contain a lease. Because then you do not have absolute control over that particular asset. Yes, you can identify this is the asset. The question is, do you have control? So as you look at the scenarios in the exam, view them one on the basis of control. Secondly, can the asset be identified? Thirdly, am I using this asset in exchange for a consideration like cash or whatever? If all these items, all these particular things that you're looking at, you are able to identify them, then well and good, that becomes a lease. So hear this out. The definition of control, when you say the right to control, you have almost similar privileges to what one who is actually using his or her own asset has. So you have those rights during that particular period of time. So if you have control, then you have possible economic benefits derived from that particular asset which you have control for. So it shows control is conveyed where the customer has both the right to direct the identified assets use and to obtain substantially all the economic benefits, or not a portion, but all the economic benefits from that use. Here it is. However, and this is chapter 16, B9. However, if the supplier has a substantive right to substitute the asset during the period of use, then the customer does not have the right of use of the asset, and hence there is no lease. If I come and say, this is the vehicle that you will be using, but along the way, after maybe a year, in the life of that particular contract, I said, no, not this vehicle, use the other vehicle. Then that contract does not contain a lease. Victor, are you getting this?
Yes, I'm getting it, Coach.
Thank you. So I would want you to discuss this part. Then after 5 minutes, you'll give me your verdict on identifying a lease. For example, for each of the two following scenarios, explain if the contract is a lease or if it contains a lease. 1, Pitch needs to transport its goods to customers in Europe using rail freight. The company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type for 5 years. 2, Pitch needs to transport its goods to customers in Europe using rail freight. The company enters into a contract with a rail freight carrier that requires the carrier to transport a specified quantity of goods by using a specified type of rail car in accordance with a stated timetable for 5 years. So what I'll do, Okay, you can tell me something here. What is your verdict? Yeah.
I think for the first one, there is no identifiable asset, and there is no element of control. Although the period is specified, we think that there is no lease there. But for the second one, if we use the 3 factors that we can identify the asset, which is a specified type of rail car. The period is more than a year for 5 years. And we think the control is there because there's a stated timetable that they will be following. So for that particular period of time, we feel that Pitch has control over that specified type of rail car. So we think that there is a lease for the second one.
Sure. You got it right. You got it right. Okay, so you're saying the problem 1, the scenario number 1, the identified asset is a specific rail cars in the contract which the supplier does not have substantive substitution rights unless for repairs or maintenance. The customer's exclusive use of the rail cars so that the right to all the economic benefits. The contract therefore contains a lease for the rail cars. The second one, that's saying there is no identified asset as the supplier can use any rail car as long as it meets the specific type of as designated in the contract, which means that the supplier has substantive substitution rights because it can use any car. As the supplier can choose which rail car to use out of a fleet, then they have substantially all of the economic benefit of the rail car, and hence there's no lease within the contract. Is it what you're saying? Hello?
Yes, that's what we.
Yeah.
I think you've interchanged the answer.
I've interchanged them, man.
Yeah.
Because it says, okay, 1, Pitch needs to transport its goods to customers in Europe using rail freight. The company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type of 5 years, for 5 years. Second, they're saying Pitch needs to transport its goods to customers in Europe using a rail freight. The company enters into a contract with a rail freight carrier that requires the carrier to transport a specified quantity of goods by using a specified type of rail car. Are you getting that? By a specified type of rail car in accordance with the stated timetable for 5 years. So
this is scenario number 2.
Yes. So the scenario number 1 says Pitch needs to transport its goods to customers in Europe using rail freight. The company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type for 5 years. Here we are going back to this part. A contract is or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. Control is conveyed where the customer has both the right to direct the identified asset's use and to obtain substantially all the economic benefits from that use. However, if the supplier has a substantive right to substitute the asset during the period of use, then the customer does not have the right of use of the asset, and hence there is no lease. Do you look at number 5? You look at it. Number 2, sorry, number 5. Pitch needs to transport its goods to customers in Europe using the off-right. It's even scenario 1, that is what it's giving you, the first part, isn't it?
Yes.
Let's use is it deductive thinking? The company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type for 5 years. The company enters into a contract with a rail freight carrier that requires the carrier to transport a specified quantity of goods by using a specified type of rail car. Tell me, among the two, who has this part? This part. The right to direct the identified assets use. And go back there.
Okay.
Okay.
We go back this side. Let's go back. Pitch needs to transport its goods to customers in Europe using rail freight. 1 is not talking about the quantities. There is no timetable whatsoever, just to transport. The company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type for 5 years. Can transport 2, can transport 3, can transport whatever. Number 2, Pitch needs to transport its goods to customers in Europe using rail freight. The company enters into a contract with a rail freight carrier that requires the carrier to transport a specified quantity of goods by using a specified type of rail car in accordance with a stated timetable for 5 years.
I think 2 has got the direct to has got control, I think.
2
has control of the control on the use of the specified rail cars.
So you think 2 there's a lease there?
That's what I thought. There is a lease.
No. That's just say yes. I think that.
Yeah, I think there is a lease.
I think 2 has a lease because I think it's meeting all the criteria.
With specified quantities. And the specified timetable. Does it mean that, again, we go back, because this is a specified timetable, guys. We go back here. Control is conveyed where the customer has both the right to direct the identified assets use and to obtain substantially all the economic benefits from that use, all the economic benefits from that use.
All right.
So now we have to think like lawyers. Representing our clients. So again, look at this. Tell me something.
Yeah, I think because of the specified, the stated timetable, it means that they might not have control on other periods. Yeah, other periods. Yeah.
And also specified quantity.
Yes.
Has Victor dropped off?
Yeah, maybe as a power cut, I think it dropped off. Oh, okay. So I think we missed it on the specified. The word specified is key there. For
because then it means the specified quantities. So what it means that pitch does not enjoy all the economic benefits.
Yes.
Because it has been restricted of how much quantities he should carry. Besides that, it has also been restricted on the issues of the timetable. So the timetable restricts him.
Okay.
Interesting, yeah, Victor, isn't it?
Yeah, it is. It is.
Yeah. But the first one, coach, it's saying any.
Yes, you know what I've done here? It's not really, I think from the lease part, because this is a real thing. All they're saying is that you need to have a type of, a particular type for 5 years. That's a particular type. Because they say the company enters into a contract with a rail freight carrier for the use of 10 rail cars of a particular type for 5 years. Not the obvious, but a particular type. So you're saying this is the type that we'll be using. It's a rail line.
Okay.
But what it shows there is that this particular customer or lessee has 100% would get all the possible economic benefits that will flow from the use of those particular types of rail cars. But where the control has more control, because the one is not dictated of the quantities that he should put on those freight carriers, is not dictated on the timetable. So has control. It's not like most of the countries where you are being dictated by IMF. So has control. The other side, it's the scenario number 2. If you're not careful, you'd actually think there's a list there. But the moment you start thinking, so if they have given specified quantities to be transported, does it mean I have control over what I should do? Transport or carry. And I've again, wait a minute, I've also been given a timetable. Do I have 100% control over the use of that particular asset? Because you need to have the right of use of asset. It makes it clear now, huh?
Yeah, it's clear now.
It's clear now.
Or there are still cobwebs?
No, it makes it clear.
So it is possible where you have an asset that is being leased. That asset, and we've seen it's basically common, where this asset, there is a cost for the asset itself and a certain component on the maintenance. And you're told this asset is so much. Let's just give this example. You buy a vehicle. If you had to buy a vehicle, say as a standalone cost, at Toyota Havoroni, this particular car, it's a new car. Maybe Toyota Land Cruiser or some kind. So we say it's $250,000. As standalone. Then maintenance. Since you'll be taking there for 5 years. Maintenance is they have computed for the whole 5 years. Maintenance is, say, 20,000. So for the next 5 years, and for insurance purposes, you can go to Bushmix to go and have your cabin maintained, because the insurance company, in event that you're in an accident, you're not being indemnified. So you're forced to go to Toyota Botswana. You go and buy. So if you're buying them as standalone, it will cost you eventually, when you look at the period of this particular asset, says for 5 years, it will cost you 270,000. But then what Toyota's Botswana does not tell you, look, that there are all these components in there, but says, no, if you want to buy this, this is it, how it is if you want to buy it as a standalone. Meaning you'll be taking this car for maintenance at Toyota Botswana. Every year, they'll be getting this 10 times divided by 12, whatever, how much it is for maintaining the car. So obviously you're going to use your 250, but there'll be this component. But then they tell you, if you are buying this car from us with all these components where we'll be maintaining your car for the next 5 years, you will actually buy it at $255,000. So you know for sure that in here, this 255,000, you should find ways of separating what is a lease and a non-lease component. But you have been given a basis of how the computation will be done. You have been given the basis. So we'll say the lease part, we need to find the percentage. It will be 250,000 divided by 270 as a percentage. What's the percentage? Then for the non-lease, would be 20,000 divided by 270. So you could just give me the percentage here for the first one.
93.
93%. Meaning this one is 7%, sorry, 7%. So you have this amount. When you're acquiring this, you go to Toyota, you spend that 255 because you have done your computation of that. This is more expensive. So we would rather get it at 255, where maintenance and everything else is there. But then in your books, you need to go and show what should be regarded as non-lease and that which is regarded as lease. For non-lease, obviously, whatever amount that you're going to have, you can, every year, you can be expensing that until it's done, but it's not part of the lease. So to be 93 times 255. That is what you're going to allocate. Times 255,000. So how much?
236.
So 236 will come in as
0.1.
or come in as part of the list, as a component that is a list. Then the difference will come in as non-list. So we should be able, even in the exam, to split these two amounts. Especially if you're given the standalone amount, then you're told, and I'm sure it's part of their marketing, isn't it? Why they're telling you that. Because there wouldn't be any reason why they should tell you that other than marketing. They know that you will still fall for this.
Yeah.
But in your books, you should be able to know how you split. What is part of lease and what is a non-lease. Okay? Makes sense, huh?
Yes.
Yeah, that's great.
So I'm giving you about 5 minutes to do your computations. The example here reads, Pierre enters into a contract for the use of an item of machinery and its annual maintenance for a combined total of $100,000 per annum payable at the end of the lease period. The rental of the machinery without any maintenance is $95,000 per annum, whereas a standalone maintenance contract is $10,000 per annum. Explain how the annual rent should be split between the lease and non-lease component. Let me know what you have done. Can you explain what has been done so far? How you have deciphered this particular question?
The annual maintenance for combined total is 100,000, and then the without any maintenance 95,000 only, and maintenance 10,000. So we say 100 over 105, and then we get 95%, which is the lease portion, and then 5% the maintenance portion.
How did you get your 5%? How did you get your 5%?
Coach, I think maybe Victor, I think I'm looking at it differently. We've been given the discounted price, right? Which is 100. Right, and then we are saying that if we are going to go for the non-discounted price, it will cost us 105. So in that case, what we should do, we should take our 95 over 105, which is the total of the non-discounted price. And then we get 90%. And then we say our additional maintenance charge over 105, and then we get the 10%. Right, and then if we now want to see what we're going to expense, then we multiply that 90 over 90 times the discounted price, which is 100. So it will remain that.
Yeah, look, you have gotten it right, because remember what we did on the 250 and 270. So first thing is, we understand these numbers, they are standalone, and we are going to use these numbers as a basis to split, because this looks like it's the actual pricing if you are buying them as standalone. If you are going for your maintenance, you are going for your machinery without maintenance. So you have these numbers. So the percentage would be 95 divided by 105, because you are adding, it's 95 plus 10,000 times 100, which gives you, what's the percentage?
The percentage is 90.
No, it can be 90. 90.7.
No, it's 90.448, 90.5.
So 90 point, let's go this 48%. So this is the number that you're going to multiply by 100,000.
Yes.
So that you only get a component, which is the list. Then the difference will actually go to a non-lease. That's it. Victor.
Okay.
Luke got it different from yours. Does it make sense now? After Luke's explanation.
Luke cheated because we discussed what I said.
He did not abide to the group code, yeah?
He did not abide to the group discussion.
No, after we discussed, I looked at it one more time, and the coach was already on. So I thought initially I thought we had got it right, but I looked at it second time. So apologies, Victor.
But Victor, does the concept make sense? Isn't it a beautiful concept?
Yeah, it makes sense. Yeah, it makes sense.
Because you see why you're having this 100,000, it's because it's discounted. But then you need to know how much is going to the machinery. If the machinery, the actual price was 95,000, the maintenance 10,000, and in total it was 105. If you're buying them as standalones, now that we are allocating this 100,000, how much will go to the machinery? How much will actually go to non-lease, which is basically maintenance? Okay. So the difference, obviously, one we have, it goes to lease rental. Then the other component actually goes to be recognized through profit or loss because it is maintenance, in short. So you're going to lease accounting. Obviously, this particular asset is leased and it is going to sit on our balance sheet. We need to know how we recognize it, the initial recognition. So the initial recognition, what is going to happen, Victor, is that we need to know how much, what they call the nameplate price. So the nameplate price is what was the price at which you obtained this. So we have that particular price. Plus, if, for example, it's a hammer mill, I'm taking it to my village in Namwala, and it has been bought in Osaka, and it's about 321 kilometers to my village. Any cost that will be incurred in transporting the hammer mill up to the place where commercial activities will be happening, all that costs and associated costs will be part of the asset base. So the initial recognition, one is at the start of the lease, and the leasee initially recognizes a right of use asset. So when you have this asset, which you bought, say in this case, we say $95,000 for a machinery, what does it do? It also creates, because otherwise the balance sheet is not going to balance, it creates a liability. So that liability will actually go and sit as lease liability. So it has created an asset, it has also created a liability. Then you now start paying, amortizing it on an annual basis. But there will be also other components that will come in. You may get an incentive like what we saw in the first example. Secondly, first you add any direct costs associated to bringing this particular asset in to have it ready for commercial activities. So that will be an added cost. If there's any incentive whatsoever that has been given, like a discount of some kind, that has to be subtracted so that we get the actual value of the leased asset. And that is the number that we are going to use, team, for depreciation. So we'll know that this is the actual amount that goes into and sits in the balance sheet. But every year we'll need to depreciate it based on the life of the contract. But then there will be other issues that will happen later on. How much do you pay, for example? What is the interest, the financial cost that needs to be accounted for? Just as an example. So we'll say you have this machinery, which we found. Let's say, for example, you bought it at 95,000. So it was bought at 95,000. This is obvious right of use asset, RIUA, and the liability will also be created. Of a similar amount. Then from there now, so we'll debit this if it's double entry, and we'll credit the liability, the lease liability. Then now there are direct costs for taking that hammer mill to your village in Mtare. So those direct costs will come in. So with the direct costs, you still debit the right of use asset. Let's say it was the $5,000. The direct cost that you incurred in transporting this particular hammer mill, specify the hammer mill to your village in 1 year. Then credit cash of 5,000. Then there are some discounts, some incentives of some kind. This discount, one is maybe a discount worth 1,000 kwacha. So what does it mean? It actually means that we are going to debit cash of $1,000, sorry. And we're going to credit, because that was an incentive, we are going to credit RUA, right of use asset, 1,000. So the total amount that we are going to have will be 95,000. We are going to have 5,000 that is coming in through direct costs, then less the incentive of 1,000. Giving us 99,000. Now, with this 99,000, we need to actually check on the contract. Let's say the contract is, the lease contract is 9 years, for argument's sake. So, meaning that we are going to have 99,000 divided by 9 years. Which then will give us 10,000 as depreciation on the annual basis, This is what will actually be depreciating the asset. Hello?
Yes, Coach.
So from this level then now, once you understand the concept, you will say, I'll give you a scenario, you look at it, you understand the concept, we'll go to the next stage now on the payments. Where based on your lease agreement or contract, there'll be lease payments that you pay. From these lease payments, we need to check how much goes to the components of financial costs, which is the interest, how much goes to just the amortization of that particular lease. Interesting, that is what we'll be looking at.
All right.
So the right of use asset, like I mentioned, it's measured the amount of lease liability plus any initial direct costs incurred by the lessee, less the incentives. And these are the items that to be looked at. One, there will be a creation of the lease liability. There will be initial direct costs. Any estimated cost for dismantling, you need to include that. That is an expense that should be part of your asset base of that particular lease. Because once the lease is done, you will need to spend costs. You should be able to estimate. Payment less incentives before commencement date. The lease liability, the liability will be measured at present value of the lease payment payable over the lease term discounted at the rate implicit in the lease. I do model IFRS16 for the company that I work for, obviously. But even my side hustles, I do that for a certain bank in Zambia. So we normally look at especially the rate. What rate do you use, the discount rate? Do you use the policy rate plus the margin? Do you use the rate at which they borrow? If you do not have this rate, what do you do? Because you need to discount. So the models, at least, which even the auditors have agreed, you just look at the Bank of Zambia policy rate plus the margin of 3% or so. Then use that rate to discount. So to show the fixed payments, less incentives, the variable payments, here you can use the CPI, Consumer Price Index or rate. Expected residual value guarantee. Should be looking as we move on. Paying out for terminating if reasonably certain that is going to be terminated. You need to actually account for that. Then exercise price of purchase option if reasonably certain. But we are saying if the rate implicit in the lease cannot be determined, the lease shall use their incremental borrowing rate. So the present value of the lease payments, why, and in finance, any payments that are in the future, because you're making a decision today, you want to account for them today, you have to discount them today. Just a basic principle. That was initial recognition, subsequent measurement to be cost less accumulated depreciation. And the lease liability side to be the financial liability at amortized cost. Then obviously the finance cost that will come in later on. Depreciation, we know where it is coming from. Obviously, it takes the life of the contract. The question reads, on 1st January 2015, Plum entered into a 5-year finance lease of machinery. The machinery has a useful life of 6 years. The annual lease payments are $5,000 per annum, with the first payment made on 1st January 2015. To obtain the lease, Plum incurs initial direct costs of $1,000 in relation to the arrangement of the lease, but the lessor agrees to reimburse Pia $500 towards the cost of the lease. The rate implicit in the lease is 5%. The present value of the minimum lease payment is $22,713. Demonstrate how the lease will be accounted in the financial statements over the 5-year period. So I'd want you to first compute the first part. The first part, the one that you bring in your direct costs, your incentives and all that, and you calculate your depreciation. So I'll give you again about 5 minutes, then I'll join in so that we finalize on this part. Okay. Over to you, over to you. What has been done?
Okay. Our present value is 22,730. So we want to determine the right of use asset. And then direct cost of 1,000. We adding, and then we less the reinvestment of 500. So the total becomes 23,230. The right of use. And then useful life is 6 years. So
useful life, that's what I want to hear from you.
Useful life, 6 years.
Why do you use 6 years when your contract, your lease contract only goes to 5 years? Okay, so the trick here is that you use any of the two, which is the area.
Any of the two, which is
If you have two numbers,
the area of
560, the area one.
Okay.
So for example, if the contract was going, if the lease contract was going for 6 years, yet the economic lifespan of that particular asset was 5 years, then you use 5 years. If the contract is 5 years and the lease payment, the lease contract is 6 years, you actually go for 5. If the economic lifespan is 5 years, the lease is 6, you go for 5. If in this case, the economic lifespan is 6 and the contract is 5, you go for 5. Always pick the lowest of the two.
Okay.
Because this asset at the end of the year, you cannot leave a value with. You remember that it is connected to your lease payment of 22,730. And that is the amount that you are trying to depreciate. Because the first thing that you have done on the minimum lease or the present value on 1st January is 22,730. So you have debited your right of use asset, you have credited your lease liability. That's what you have done, the first part. Second part now is you have the direct cost coming in of 1,000. 1,000 direct cost. You debit the right of use asset, you credit cash because you're using your own money. The third transaction is the incentive. So the incentive comes in, you debit cash, you credit the right of use asset. So what it means then now, you have all these numbers. You have 22,730 plus 1,000 minus 500, which then gives you, is it 23,230?
Yes.
Divided by 5, whatever amount that you get, that becomes your dip.
4646.
Or 4646.
46.
Okay. So the next stage now is to check on the finance costs, the lease payments, because you have been given that. So I told the rate implicit in the lease is 5%. The present value, blah, 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 demonstrate how the lease will be accounted in the financial statements over the 5 years. So this is what we'll do. Mark this number first, mark this number and this number. In the lease payment, we will not use that number and this number here. And this number here. In the lease payment, when you're paying, we will not use this number. Most students will get confused because if you check how this number is coming in, it's through the direct costs, the incentives and the like. But what we'll be paying the leaser. We will not be paying this to the leaser. We'll be paying this. And this is what we want to see to amortize by the end of the 5th year. This amount must be amortized. Do we agree?
Yes.
This is what we owe the leaser.
22,730, yes.
We don't owe the leaser this amount here. This amount has come in because you're putting the direct costs and the like. So if you are looking at how the liability is going to go under, It is through this. And if you have checked the double entry, where we have a liability is on the first part, where we are saying debit the right of use asset, credit the lease liability. In the second one, we are actually saying debit the right of use asset, credit what? Cash. In the third one, we are saying debit cash, credit the right of use asset. So this is the amount that will be left, 22,730. So it's this, the 5%, and the payments of 5,000, and we'll end there once we do it correctly. So I'll do this. Let me share. Bring in the whiteboard. Okay. So we'll start with the years. This contract, it is for how many years? 1, 2, 3, 4, and 5. So we have the balance brought forward. So in the first year, on 1st January, how much was there? Was it 22,730. When we debited the right of use asset, we also credited the lease liability. We agree with this number, isn't it?
Yes.
Yes.
Then, how much, what was the payment? On 1st January, I mean, we paid a 5,000. This was paid. So we come this side, we have capital balance. Capital balance is 22,730 minus 5,000. How much do we have? Hello?
22,730 less 5,000. But 17,730.
So it should be 17,730. Okay, don't leave. We'll be done with them. We'll look at your case for even 30 minutes, your modeling. Don't go.
Okay.
So we have the capital balance of 17,730. There is a finance cost. What's the percentage?
5%.
5%.
5%.
So it'll be 5% of this 17,730. You know why? Because the payment was done on 1st January. So to be fair, you cannot use whatever, you use the closing balance. So 5% of 17,730, how much you get?
887.
887. So what is the balance carried forward? Oh,
16,844. 16,844.
No. The finance cost, you haven't paid it.
You're adding it.
You're adding it. Oh, sure.
Just added the capital balance.
18,817.
How much?
18.
18. Hello, Victor. Hello? I've lost what I was doing. Yeah, I've lost what I was doing. Okay. I'm sure you have done your computations. First, you have year one. 1, 2, 3, 4, 5. You have the balance here. Brought forward, which is 22, 713. Then you have your payments.
Payment, which is 5,000.
5,000.
Then capital balance.
Then a capital balance.
17,730.
17, 713.
730.
Then you have the finance cost.
887.
887. Then you have the balance carried forward. Mm-hmm.
18617.
617. Which then will come this side. Let's just do it quickly. Which will come here as 18,617. Again, payments of 5,000. It will take the amount to how much?
Is it 18,617?
How much?
13617.
13167 or 617, sorry.
13617.
617. Okay. So what is the finance cost at 5%?
681.
681. What's the balance carried forward?
14,298.
14,200
and 98. 14,298.
Okay, 298. Which will come here as 14,298. Then minus 5,000. This goes to, is it 9?
9298.
9298.
Yes.
What's the percentage? What's the thing here?
465.
465. Giving about how much?
9763.
9763. Which will come this side as 9763. So minus 5,000, it takes you to how much?
4763.
4763. And what's the 5% there?
238.
So what you check, what you do, because this is the last, you know there were decimals and what. You need to check that the amount that you get here should equal to your lease payment. So obviously, because there were decimals, here you're 4763. So all you do is say 27237. Because they are decimals. Otherwise, if you use whatever, it should take you back to this amount here as a balance should be 5,000. My internet is not good. I'm sure I've lost the data. But what I was saying, I've lost that data. What I was saying, that 238 you got, you need to match it so that it gives you a 5,000. So you put 237 because they were decimals, they were rounding off. So that the last balance, the balance carried forward will be 5,000 at the end. Then meaning that in the fifth year, that would be a balance of 5,000 plus your payment. Then by that time, you would have amortized the whole lease liability. Do you get it?
Yes, I got it.
Look, do you get it? We are done here. Do you get it?
Yes, I do, Coach. Thanks.
So tomorrow we'll continue on leases. You have quite a number of things to look at until we go up to lease payment, until we go to lease paybacks. Well, a lease back, not a payback, lease back. So today's class we are done, but then you need to check out, both of you, but you know what we do. I'll start with Luke. Do the checking.
Thank you. Thank you, Coach. Enlightening, and the way you explain it, the way you explain it, or you put it across to us, makes it easy for us to, especially for me to grasp the basics and concepts. So I think so far so good.
Sure.
Thank you.
Thank you, Luke. Victor?
Yeah, I think Luke sums it all. The same to me. The way you phrase it makes it easy to grasp the concept. So it was just easy. And then even if when you make mistakes, when you come after the discussion, when you come, the way you say some things, memory peg.
Yeah, the memory pegging.
Maps you. So
sure.
I'm excited about it.
Sure. Thank you so much, and see you tomorrow. I'll continue with the.
All right. Thank you, Coach.
I'll continue with my young man, Kawuswe. We are looking at some financial modeling issues. So thank you so much for that. But I'll have some class with him within 30 minutes. Thank you.
Thank you, Coach. Good night.
Thank you.
Thank you. Good night. Good night. Thanks.